excited about our guest. If you're a founder, if you know a founder, if you want to be a founder someday, this is one you really want to pay attention to. We have Brett Queener from Bonfire VC. Bonfire is a name that many of you already know because they're one of the most famous, most well-regarded seed stage venture capital firms. Brett, I'm so glad you could join us on the podcast today.
Wow, that was really nice. Thank you. Yes, I'm excited, Lisa. The first time I met you, I was like, we have to find a way to do more together. And oh, by the way, kudos on your recent recognition. That is huge from Business Insider as one of the top 30 female VCs out there. That's not easy to get on.
Thank you so much. I appreciate it, Brett. It was really nice to be honored that way. And of course, some of my favorite women VC GPs are on that list in positions 1, 2, and 3, like Eileen Lee and Kristen Green. So onward and upward. And speaking of that, Bonfire is really well known in the venture capital community as just a top rate seed lead VC. Could you tell me a little bit more about Bonfire and how you came together?
Sure. I mean, it is real rewarding and affirming, right? It's not an old firm. We are just on our third fund. We raised our first fund, I think it was 2017-18. So really just on our third fund. When we came together as Bonfire, the idea was that we would focus primarily on software because that's what we knew. And we were going to lead seeds. And by lead, we really thought about what that means, which is really sort of your first real financial partner on your cap table, on your board, and who's a firm that is going to lean in this seed journey, because the Seed-A journey is really hard. Like, it's hard. Like,
we are going to so get into that, Brett. For the audience's sense of the trajectory of Bonfire, what was Fund 1, Fund 2, Fund 3 in terms of size? Because there's been a significant amount of growth there.
Yes. Well, I mean, as somebody once says, the enemy for the VCs on the call, the enemy of large returns and good returns in seed is the size of your fund, right? But our first fund was 60 million with 2 primary investing partners, Mark Mullen and Jim, who are often ranked the top VCs in Southern California. The first fund was primarily focused on investing in B2B, primarily in California and Southern California, because our belief was to be helpful, you have to be hands-on, and so the location matters. Fund 2 was 100 million. That's when I became a full-time partner. Expanded reach to across the United States as our reputation grew. And then obviously with COVID, the idea of location sort of was secondary. And then mid to late last year, we closed our third fund, which is a $170 million seed fund. Just quickly, we do not place a ton of bets. So, in a $170 million fund, we're probably doing 25 core positions. 40% initial, 60% follow on. And so, each investing partner is doing 2, maybe 3 deals a year, but that's it.
That's a lot of attention that you're able to give to each of those companies. And no doubt a big reason why a software founder would be wise to take a look at Bonfire. That's really different. For founders who are considering VC, I just want to mention that many firms actually use portfolio diversification, making 100 bets out of a $170 million fund. And that would be much more typical. And so Bonfire is visionary and very leading in this area, is that when they have high conviction, they're in it to win it for the longer haul. And so, Brett, what does that look like? What kind of founders are you seeking today?
We'll get to my background, right? But I spent over 25 years as a software executive at some of the most successful software companies. So I will speak to what I look for, and it's somewhat the firm as well. I'm now, I can't say I'm an operator becoming a VC. It's been 4 to 5 years. What I describe is you fall in love on the first call. Like, I think you either fall in love with the founder or you don't. And that's okay. It's different strokes for different folks. And then I think you use logic to do due diligence and decide to back out. Ones that generally don't work are ones where like, oh, the founder's fine, there's something there, et cetera, et cetera. And then you sort of convince yourself to do a deal. So one, I think we're looking for outstanding founders. I think what people forget about venture capital is you only really make money when you have an outsized exit. And as a seed stage investor, we won't know for like 10 years. And, I know a lot of people love to mark up look how well I'm doing because the A went up and the B went up. But at the end of the day, it's all about returning money to your investors. That only happens when there's an exit.
I couldn't agree more. All of this interstitial markup play, IRR, and et cetera. I mean, of course we do it. We have to do it as the industry standard, but you are calling out something that we also believe a great deal. And I think founders need to hear that too, because there's not a big win for the company in the markup. There's a big win for the company in creating a massive, epic exit. And, thank you for bringing up your very unique background, Brett. I would love to walk through it a little bit and focus on what you learned at some of those companies where you were a core part of the team that you carry into investing. And if you don't mind, let's start at the beginning. I think Siebel was one of your first leadership positions early in your career.
Yeah, after business school, I worked with Tom Siebel and the team there. And Siebel was, the first breakout star in the CRM industry back in the day when it was installed on CDs.
Wow.
And so that was, at some point, I think I joined just after the IPO. And, the company got to some point worth, 20 to $30 billion, multi-billion in revenue. And there I learned about the alignment of execution and making sure everybody was sort of aligned in a row to go execute across the different functions. My formative years is from Siebel. I joined Salesforce.com really early. When Salesforce.com was a product that had 4 tabs, no dashboards, no customization, and our logo was point, click, close, and it wasn't called cloud. I think it was called on demand. And so I joined very early in 2003, and I spent 12 years there in 3 primary roles. One, which was really on the go-to-market side, which was, what is this go-to-market model for SaaS? Because people forget, prior to SaaS, you didn't sell direct to every segment of a market. Like it used to be, you sold to enterprise customers and you flew around and there were multi-million-dollar deals, and Anderson Consulting charged $10 million and you paid $5 million for compact hardware. Or you sold through a channel, or
Right.
it was shrink wrapped and you could buy it at Fry's or through that was the model. And so what was very interesting to me about Salesforce and the on-demand model was, if you could pair up the right product and packaging with the right demand generation strategy and the right sales cycle and skill sets, you could probably build a machine that would allow you to sell across every segment over time. That was the thesis. And so I spent sort of the first 3 to 4 years there partnering with a gentleman named Jim Steele, who was the CRO, to basically build out the entire sales organization.
One of the big challenges in early Salesforce, and I know as an early and longtime customer and a current customer, I love Salesforce. But I will say the implementation challenge, the heavy lift of implementing and getting the full benefit, has always been something to overcome. And I think that in the early days, of course, it was even more so. How did you overcome some of the lift of getting Salesforce's abilities across an enterprise?
Well, remember early on, when I joined, we had like 10 sales reps selling over the phone, and we just hired our first enterprise rep. And so the product out of the gate was easy to deploy. There was no configuration, very little customization. There was no API and the rest of it. So I think it became an evolution over time where we invested in mid-market, went up, and then went upstream. And then, the reality had to make a conscious choice, which is, the way I think about it is that, it started out as a very simple to easy to use utility. And at that time, it was easy because people were using Siebel and all these enterprise solutions they deployed and had all these features, but no rep used it. So like if no rep used the product, then the reason you bought the product was to get all these insights. You weren't getting anything. I think as we moved up market, it's a very tricky thing.
It
You know,
is.
I'm on some boards of companies prior to Bonfire that, you know, north 100 to $300 million in revenue, which was invariably you start going up market. It's very hard to be the best solution for SMB, mid-market, and enterprise. You kind of have to pick. And I would say along the way with Salesforce, we went much more to what I'd call a metadata customization platform, where it was very configurable. You could make it do anything. We launched the App Exchange, integrate with stuff. Which then the challenge though is, you know, it's harder to use if you're just an SMB.
So what do you say to startups today? Because many of them who are listening to us now feel like they could be the solution for everything. And I can think of portfolio founders in my portfolio now that are literally, but we have customers who are SMBs. We have mid-market customers. We've sold 5 or 6 enterprise contracts. Why can't I build it all? And do you still believe that's not possible, Brett?
That's a disaster.
Yeah, it is.
I mean, that's an interesting conversation to have like post 15, 20, $25 million in revenue.
Right.
But when we work with founders, like you work with them often before us or at Seed, you have a limited amount of capital, you have limited knowledge, right? Like you know 5% of what you should know. And it's not a criticism, like you've not been around that long. You've only
It's just
talked
a stage reality. It's just a stage reality. Yeah.
So when I say what do we need to do to get to a Series A? And let's be clear, what do we need to do to build a great company? These concepts of Series A and Series B, these are fundraising events. And often I think in the last 5 years, people have thought about, what do I need to do to raise the next round? We should think about what do we need to do for the next phase of this company? And I think of startups like building a house, right? You got to start with the foundation, then your first floor, and someone's like, hey, look at this amazing TV room on the 3rd floor. I'm like, you've got no friggin' stairs. You're gonna fall.
I think, Brett, so this is a very living concern, and I speak to, you know, literally dozens of founders a week, as I'm sure you do. I think they feel that they're giving up money, like leaving money on the table by not pursuing the entire demand curve.
Sure. But the question is, let's just say when you get to Series A, what does a Series A investor want to know? I want to know that you've proven that one motion works. Look, at Seed, there's like 5 to 10 people. Everyone's running around like a scrum. Every decision is a scrum decision. There's no specialized resources. You know, one person does all success. Okay, great. Is there a different product team and a dev team? What? Who does design? The CEO does. Okay, good luck with that. So it's like a scrum. And so you raise $2 to $3 million in your seed. You need to get to like north of $2 million in revenue in like 2 years. You have to pick a path because you need to align the product you're building, your demand generation motion, your sales motion, and your success motion. And if you try to be all things to everybody, it's impossible for you to build that motion. I have a blog that I posted a while ago. It's a favorite. It was a book that I read for my kids. It was a Dr. Seuss book. It was called If I Had Duck Feet. And there's this kid who's like, you know, he's like, if I had duck feet, I could splash in the pond. And then if I had like tiger claws, I could do this. And then if I had a giraffe neck, I could do this. And then he gets this great idea and he's like, I'm going to have all of these. And then what happens is the town gets scared. They call him a which, what, who, and they put him in the zoo. And he's stuck. And then, of course, it comes back and it says, you know what I'm going to be? I'm just going to be me. And so I think from seed to A, you need to pick a path. You need to pick a path on who your ICP is. You need to pick a path whether you're an SMB motion, a mid-market motion, or enterprise. And the reality is the 2 easier motions are SMB and enterprise. The problem in enterprise is your product is probably not there from a maturity perspective. The tricky one is the mid-market because you're sort of all things to all people. So, and because if you think about from seed to A, what does an A investor want to see? They want to see the signs of some repeatability. So,
Yeah, something that can scale with
yeah,
that growth money that they're putting in and scale significantly before you have to explore other options. And one of the ways I talk about it with founders, and sometimes this resonates and sometimes I need to pick a new way, is that today you, the CEO founder, you are all things to all people, and you can handle the spectrum of conversations because you own the full vision of your company right now at this 5 to 10 person environment. You have complete control, so it feels very comfortable, but you don't scale. And you're going to be asking people to get in a role and deliver consistent and increasingly exponentially difficult results. And
right.
so they need focus from you as a leader. Now you have to pick the focus area. No one's going to tell you what to do. But the people who love to work in enterprise and work with the big brands, the Home Depots of this world, the Coca-Colas, NCRs, that's an entirely different mindset and experience set, and sometimes educational background, than people who are great at the SMB sale. And so do you want to create a scale problem for yourself, or do you want to make it simple for people to follow your leadership? And I think I have about a 50-50 hit rate on that.
Yeah. Well, I mean, what I always tell people is, okay, you've hired a salesperson. What do you think that conversation is with a 5K deal, a 50K deal, and a 500K deal? And have you ever met a person that's good across all three of those? And what are those skill sets and what the economics are? Oh, it's success. Oh, I've got a self-service application. It's a $5,000 deal. What support's needed? What support you think you can afford? Oh, it's marketing. You got a marketer, and the first marketer falls in this vortex of doom. They want to trade. Okay, so are we doing enterprise where we got to go outbound into the ABM motion? We're really doing PR awareness so that when we do prospecting, they know? Or is it SMB where it's all about SEM and SEO and lead conversion? And if I go to your website and I'm an enterprise company, I go to your website and it says SMB, mid-market, enterprise messaging, do I think it's for me? When I say that to them, they go, okay, fine. And then I ask them, who would you hire for that position? And then they realize those people don't exist. But anyway, so just finish at Salesforce. I then ran product, which was fun for about 4 years. And that was where we were primarily a mid-market SFA company. And I worked and hired great leaders. And we moved into other adjacent multi-billion-dollar segments like the contact center.
So, Brett,
Yeah.
how has enterprise software sales evolved? What was true, if anything, that is no longer true today as you look at some of the best companies in your portfolio?
What I think there are many things in enterprise sales that are the same. Although I would say in the last 5 to 7 years, we've lost some of those good habits. Like it used to be an enterprise sales rep has to prospect and not wait for like the SDRs to give me leads. And then
Marketing qualified leads, man.
the lead isn't there. And I'm like, do you realize there's a rule of thumb that's always been the case for 30 years? Marketing will deliver a large amount of leads down market. If you're relying on them to deliver a lot of leads up market. What I will say is the biggest difference is that many years ago, seeing the product and understanding how the product works and how someone would use it would be much later in the cycle. And so I think much earlier in the cycle, the customer is looking at the product and getting context and the rest of it. Used to be many years ago, you could do your Miller Hyman spin selling and the rest of it, do a bunch of deep qualification, negotiate for time, et cetera, et cetera. And then at some point, then an SC would show up over here, and then like it took a while. I think at the end of the day, you need to bring the value of the product, and people need to visualize using the product much, much earlier in the process. The rest of enterprise selling to me, I think is still very much the same. I think at the end of the day, look, here's what I would say is true about selling, regardless of SMB, market, and enterprise. If the buyer doesn't really understand relatively quickly, why should I investigate this category of software you're in? Like, what value does this provide me? Why are you the right solution within this category? What is it that you enable me to do that others cannot? And then why do I need to buy this now? Like what happens to me if I don't buy this? So like sometimes I'll, for our portfolio companies, poor companies, I'll do forecast calls with them because they ask me to. And
Absolutely.
I'll ask the rep, if I ask the buyer what happens if they don't buy this, what's the answer? And if the rep's like, I don't really know, I'm like, well, then there's no sale there.
So true. And what kind of lead times are you seeing on enterprise deals now versus say 10 or even 20 years ago when you were first involved?
Well, right now, it depends on what sector you are. There's not a lot of buying of software in certain segments, right? Um, I mean, it's getting better, but uh, I generally, in my mind, think of SMB as less than a 30-day sale, right?
Mhm.
I think mid-market is less than a 90-day sale, and I think of enterprise of 6 months to a year. I do think what is interesting about enterprise now that wasn't the case 15 to 20 years ago um, is the concept of seed and grow. I mean, Salesforce, we did do that, right? Seed and grow, which
Sure.
is there an opportunity in the past when you're selling enterprise, you would try to sell the whole Magilla gorilla. You talk about phase rollouts, and it takes a long time, and you don't see value for a year. The challenge with that is that creates a lot of risk for the
Yes.
buyer.
A lot of
And
pressure for the buyer on that kind of a timeline these
so
days.
that just creates a ton of friction. And so I think over the last 20 years with usage-based models in a lot of these, uh, I think organizations and software companies work with are much more likely to go get it in, go get a win, get started. As long as you don't mistake yourself that it ends like a low-level manager and they're playing around with it and the executives don't know. But I think the concept of doing proper seed and grow where people see the value is great. And what I tell my firms on that is that you realize that if you go in and it's successful, you now have pricing power because like discounts
They
and
need you. Yeah.
they need you. So those are the big differences. But I think, look, I still think the basics of enterprise selling of planning value, and I think the big thing with enterprise selling is, where it's a difference when I see SMB or mid-market reps are trying to sell enterprise struggle, is they don't understand that like there are multiple parties you need to talk to. Your champion may not have power, right? And how many
Right.
deals have you heard like, well, the champion went to the CFO and it didn't get approved? Like, well, what did the champion present? Did you review what the champion ahead of time what the business case was? Did you get the champion's boss?
Have you talked to the CIO recently? Oh,
Did you introduce two or three reference people like customers who had the same concerns around the investment value and now feel very good? Um, so, my hope is we get back to some of the things that always worked.
and then I noticed you went a COO at Smart Recruiters, and that looked like quite a run. And what a fascinating shift. Tell me what you learned at Smart Recruiters and what that journey was like.
Yeah, I had worked at two very successful software companies. I believe I was well regarded there, but I often felt like the CEOs were so impressive that like if I was there or wasn't, so I was sort of this midlife crisis, sort of like, am I a fraud? So let me go do a pre-revenue company. Woo! So
Hot. That's hot, Brett.
I joined a pre-revenue company that at the time was freemium. We'd never hire reps, partnering with a visionary founder. And then quickly realized after hiring my first 30 to 50 people, I was pivoting it to a, an enterprise play. Um, and what I learned there, you know, uh, I won't use the rap music like Ben Horowitz thing, but I learned the hard things about hard things. Um, I learned a lot of the mental stress and the loneliness of being an early stage co-founder executive. I learned that when the business isn't succeeding, like when you work at a larger company, if things aren't going well at night, you can blame the man or the woman. It's the boss's fault, et cetera, et cetera. But when it's your baby, every mistake you take so personally.
So true.
And so, I learned through a lot of trial and error what not to do. And I learned to try to find the way to bring the energy to work with also sort of giving yourself self-care afterwards. And so for me, I think it brings a lot of empathy when I deal with founders, right? Because from pre-seed to seed to A, I always like the analogy is it starts out like you get punched in the gut like 30 times, and then somebody grazes you, and we should take that and throw a pizza party. Like that's a good moment, right?
That's a great moment. They didn't say no, they said next quarter. Woo, okay, celebrate.
So I think I learned a lot sort of
Yeah.
about that, and so it's interesting. The key thing that I say to founders often will be on calls, they're like, da, 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 and we had this great call, and then they move on, like, wait, stop. Let's talk about that call. Why was it great? What's your takeaway from that? Because pre-seed to seed and seed to A, it's all about rapid learning loops. Like you're trying these things, is that working? Why is that working? Let's do more of that. We did that. That didn't work. That was stupid. Let's write that down and not do that again. And the reality in life is we never learn from wins, right? You only learn from like stuff that sucks, because then you go, oof, that doesn't feel good. Let me think about that so I can avoid that.
Absolutely.
And so, I often say with my founders, they're like, oh, that's really wise. I'm like, well, that's only because I've messed that up like 6 times a Sunday. So I can be like, you can try that. But, like the new thing the last couple of years was like, I have an all bound. What does that mean? The same person qualifies inbound who goes outbound. I'm like, well, it doesn't really work. Or, you know what? For good leads, because the customer wants it, we're going to bypass a qualification team and it's just going to go to the reps. I was like, well, I'm glad you set up all this HubSpot and Salesforce process. You just threw it out the window. And I'll be like, that doesn't work.
And all the metrics associated with it that you're going to use to forecast your quarter when you're worried about making payroll. I mean, you need it to be good.
So I just often I'm like, or the new fun thing over the last couple of years was like this hunter farmer model. You know what we need to do? We need account managers instead of new business. And I'm like, in enterprise, it doesn't work. Like, and then they'll do it for a year or two and they'll go like, oh yeah, I guess that didn't work. And I'm like, hey, so that all comes from that experience. So it was hard, but we persevered. And I also learned the power of grit and perseverance and personal belief.
So
And
Brett, I want to follow up on
yeah,
something you just mentioned that I think is so important at this stage, and you've been through it personally, recognizing the importance of actually managing your own personal energy. You use the word self-care, and of course, a lot of other things around that. I would like to ask you how you learned to manage your own energy, like to take care of yourself, because I think that is a skill that really separates the people who can run the ultra marathon of building an epic, valuable company from people who maybe could, but burned out because of all of the stresses and pressures.
sure. I think it's also important. I always joke that sort of the last 3 to 5 years has been unfair to founders in that people are like, what do you mean they could raise money to all these things? First of all, we misled founders to think that all companies are venture capital fundable. They're not. I'd say half of the calls I have with founders, I'm like, that sounds like a great business. Don't
Yes.
raise venture, or raise one round, but don't raise venture, because all they'll care about is getting to $100 million. I don't know if it's a $100 million revenue company, but if you try doing that, you'll die trying and you'll feel like a failure. And even though you build a good business, and you won't own any part of that company. There's nothing wrong with a lifestyle business, right? Where you
What
can
is
get,
not sexy about being the founder of a $15 million a year, absolutely stable business that helps your customers? I have that conversation several times a week too. And I'm like, this is amazing. You should be incredibly proud of yourself. Maybe you'd like to be an LP, but I don't know that you want venture. It's so
yeah,
true.
so that was one. Two, we got everybody caught up in raising money, and then there was so much money available, and we forced founders to pretend that they knew more than they knew to go for it, right? Like we had people at like 200,000 revenue getting big A rounds, like, okay, now I'm going to go hire 20 reps and this and the rest of it. And you're like, do you really have market fit? Do you have repeatability? Not. And then it blows up and then they feel like failures.
Or they've never managed three
Oh yeah,
people.
oh yeah,
Yeah.
right. So
And that too, I mean, management is a learned skill and it's a learnable skill. And I think really anyone who wants to learn it, you can learn it. It's okay.
yeah,
But
but
you're
you
not going to learn it overnight.
No, and Lisa, you and I are not 20. And so we had the advantage of going to like being hired as being a star individual contributor for a couple of years, senior star individual contributor, and then you were a manager and you were terrible in your first year because you were like micromanaging, and then you realized that wasn't. We had like 5 to 6 years to learn this. So it's very hard. And then so we just put founders on what I call this mental health roller coaster. The equivalent I used was, let's put a founder, tell them go run a 6-minute mile on a treadmill, and then put Crisco or oil on the treadmill, and then give her rubber ducky boots and say, how does that feel? Doesn't feel great. And so in terms of self-care, what I try to tell founders sometimes is, what a gift and what an opportunity you have to go for this moonshot. And it is a moonshot. 99% of startups fail. And make sure they understand that. And what a gift that you get to do this. 2, it is a marathon, not a sprint. At the end of the day, if you're doing a software company where we invest in, you're not really worth anything till like 10 years from now. This is a long journey. And the reality of public software companies, 95% of the market cap gain is from year 11 to 20. And so as long as this is a product that you are super passionate about, that you can't imagine not existing in the world, it's going to take time, 1. 2, and this is easier, Lisa, for yourself and other older people. As you get older, you come to terms with what you're good at and what you're not, right? And then you learn where you're not good to supplement that, and that's okay. It's just be clear on what you're good at and what you're not today, and recognize that. But then also recognize you can't work on all of them at some time. You can pick a couple.
Right.
And then the third one I spend time with is, I worked in high pressure software companies for years. I was on the road for tens of thousands, hundreds of thousands of miles a year. I didn't have the opportunity to spend time with my kids when they were young. Thank God my wife was there. Now, they just graduated, both graduated from college this year. I've spent a lot of time with them the last 5 years, because working with them is kind of working with young founders. It's a lot of, I know it's hard, but I have confidence you can do it. So I also, often the founders that are younger are also doing this, and they're raising families. And I tell them, you cannot bring this home. You cannot bring this home. You need to have separation, or some separation. You can fake it. But when you go home, this is the challenge with virtual working from home, because there's not that line. But back in the day, I used to commute for like an hour and 20 minutes. I didn't love the commute, but there was a clear separation from work.
For sure. Yeah.
Home. And your family needs you, and they don't need that stress. Now, what I will say to them is, all of you have some version of the math class dream, right? It's the dream where like there's some math class you show up for, then you haven't studied for the final. It's some version, there's some anxiety dream like that. Every founder has it. And so I try to get them to name the anxiety. The one I had at the worst was, I was on Broadway. I was coming on stage. I was the lead actor. It was opening night. My family's there in the audience. The New York Times in the audience. I'm naked and I forgot my lines. And I'm asking myself, do I go out there or do I not? And then you wake up. And where I break that down to founders, I said, you're stressed about sort of 3 things. One of them is, what is it? Well, first I start out with, what do you feel good about? I always try that with each call. Second question is, what is it you wished you knew so you could go and try to attack it? The more stressful one is, you believe you know this, but the team you have can't execute against it and you don't know why.
Right.
It's one of those 2 stress questions. So I just try to get people to name their stress, and then let's get into it. And I would say often people don't understand, and it varies by your Myers-Briggs. Um, but there's so much strength and vulnerability.
There absolutely is. And
Yeah.
one of the things that I wanted to follow up on there was this idea of strength. And you're right. For people like us, we've been through a few reps, and although I feel like I have plenty to learn about myself, I have learned a lot, thank goodness. When I went through the Kaufman Fellows program, one of the things I appreciated the most was their focus on, once we got some of the weaknesses and learning where your weaknesses are and resetting all of that, not just what your strength zone is, but maybe where your greatest strengths are, so that you can build a team around you that are incredibly strong in other areas, not just supporting your weaknesses. And I found that to be a very empowering approach.
Did you do the Strength
I,
Finders? Was that the Strength Finders one? What did you do?
they used several. So they actually, Kaufman Fellows orchestrates a number of indexes. They did not do strength finders, although I've done Gallup strength finders before and I use it with my teams. But they had the Myers-Briggs, so they took that. They took a kind
What
of a
are you?
weaknesses and dark side index, which I can put in the show notes, a link to that. And then a third profile that was really about your own vision for the future and what's made you successful to date, that really just looks at your behavior. And there was one other, and I'm forgetting the name. Again, I can put it in the notes, but it was the confluence of all of these in discussion with your peers, other VCs, where they made us write what we believed our greatest strength/skill really was, so that we could choose to focus more on something we might possibly be world class in, as opposed to playing with a whole bunch of pretty goods, which I thought was fascinating. So I wanted to ask you, with that kind of thinking, what are some of the things that you consider really strong personal strengths you bring to your work as a VC? What are you confident in that you're bringing to the teams you're a part of and the lucky founders you back?
Well, let me talk about the firm first, and then I'll talk about me.
Sure.
Um, we are not, I don't know if anybody understands the economics of seed stage investing, but once you make your capital calls, you might break even on a year, and then in 10 years, maybe there's money. Like seed stage investing, you do this because you love the art of the craft. You do this because of the potential of working with a founder and seeing them sort of overachieve. Like last night, we got great pictures and a great notification. A young founder called Matt Dana, who'd partnered with a guy named Sean Stravopoulos. And I remember meeting them as we done the investment. There were 4 of them in a little incubator office in LA. And they're sort of the next generation OS software for salons. And last night he won the one of the regional winners in California for Ernst & Young Entrepreneur of the Year.
That's awesome.
And sort of watching his evolution, or maybe he'd managed 1 or 2 people in his past to become building a great company, a great product, but watching his personal leadership grow. This is why we do this. So I think 1, it's the motivation of why we do this. I think we bring a lot of empathy. We care very much for the founders we work with, and we want them to succeed. 3, we know software. I've been doing software for 25 years. Mark and Jim have been investing in software for 20 years. Yes, there are differences, whether SMB, mid-market, enterprise, marketplace, blah, 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 blah. But there's a lot of pattern detection, right? So we believe that we can help accelerate the learning curve
Right.
of the founder. We also spend a lot of time. You know, I just recently did an investment, it's not announced yet, but a company called TeamSense out of Seattle that provides software for factory workers. It's all message-based, because if you work in a factory, you're not going to install an app on your phone. So there's no way for the factories to have any type of digital communication. But in terms of time, we will talk to you at least weekly. If you don't have the time, it's fine. But we do 6 workshops out of the gate. I probably spent 25 to 30 hours out of the gate after the investment. So, okay, I know what you had to present to us. That's what you had to present to the VC. Let's just throw that away. Let's just get down to turkey and let's really dig into product roadmap. Let's dig into messaging. Let's dig into your sales strategy. Let's dig into your pipeline strategy, because in the end, we need to make sure that you have a clear set of priorities for the next 2 years, an investment plan that supports that. And let's identify what are the core areas or issues that you want help on. So, if somebody works with Bonfire, we're going to get deep with you. We're going to care. And the other reality is, by the time you get to the A, you are going to have a well-balanced investment structure. You're going to understand your business well, and you're going to be incredibly positioned to raise an A. We have like an 80% graduation rate to A, which maybe is too high. It may well be that we should be taking more flyers, but we pride ourselves on working with our firms to get them to the next level, because we have deep relations with the Series A and B investors, because they know when they get a Bonfire company, it's a great founder and it's buttoned up. Like, they don't need to
And by definition, a coachable founding team, because they've been through this process with you. And so that next investor that wants to accelerate them even further and has an even higher target on returns, they're going to know that they've got people who are used to listening, used to collaborating. And I think that's a wonderful model. We just this month did our annual anonymous portfolio company founder survey. And I will say, relating to the strength of the platform you're building, they almost all put soundboarding and that kind of guidance and close leadership right at the top. That's really what founders want. And it is so rewarding to have the kind of team that can give that to them. That makes a lot of sense, Brett.
I'm sure you're similar to us, which is what you probably tell the same thing to a founder, which is like, look, there's a board meeting. We're not going to be surprised at the board meeting, right? If there's a board meeting, we're the only people on the board. When you call us or we talk, I want you to tell us what you're worried about or what's not going well, and that it's okay to tell us that, right? You can write your monthly investor updates with all the good news, but if you're calling us, there's something bothering you, and let's just and can we create a safe space to just work through that? And I think that's really valuable to the founders.
I think, and that's also, just speaking personally about it, it's also one of the reasons I'm in this business and started a seed firm. As I've gone through my life, and also some of my close friends founded great software firms, it is just too lonely. The path is too unbroken. You can't learn it from a book. There are great books out there. There are great podcasts like this one, and you can learn a lot about it. But the doing is so situation dependent. Your CTO dependent, your product vision dependent, your sector dependent, that it is truly an art. And having people with you in that art who can share real experiences and increase the options of your experience set so that you have more ways to go. I love doing it, and I know you do too. That's, I think, why we connected when we met. It's really exceptional.
You didn't realize you've become a therapist, right? But now we have, right?
Yes, to some extent, and that's well deserved. And I love my weekly check-ins with my founders. One of them, just this last Monday evening, was like, "Thank you so much. You've been so patient with us." And we've only been invested for 18 months. I don't consider that so patient yet, but he did. And he's like, "We've been through so many ups and downs." And I went, "Hey, of course, I signed up for that. Actually, I did not expect the hockey stick. That was just your projections. I liked your projections, and now we're really in there." But let's talk a little bit more about the view that Bonfire has on the founders you're investing in. I was really interested that you said, Fund 1, we stayed local. Now we've expanded our capacity to go national. Has that changed anything about the approach, your broader scale?
No, it just means everybody now wants, with COVID's over, they all want like 4 in-person board meetings and a board dinner. So it's a lot more fly-in. I've convinced them, like, let's do 2 in person and 2 virtual. I don't think it's changed a lot. I mean, look, I think the reality is there are concentrations of talent. There are concentrations of expertise. AI now, San Francisco's back. But there's nothing that says a software in Florida is going to be any better or any worse than a startup in LA, right? I think it's just a question of the support. So I will say when we invest in cities outside of sort of the LA Bay Area, we will look to make sure on the cap table if we can include a great local firm like Valor, we work with folks in Denver, et cetera. There's somebody there that they can go into the office. Right?
Yeah, I can see that. And we feel the same way, even when we just led an investment in Florida. And actually the last two investments we led in Florida, Florida's not that far. I'm in Atlanta. Florida, though, it's a long state, and getting there can take time depending on where someone's located. We looked for a strong, experienced, seasoned Florida-based co-investor, because while Atlanta is not a big flight issue, there's something about someone to have a cup of coffee with that never gets old. Some things are so personal and so difficult in those early startup journeys that cup of coffee conversation is valuable. And we want our founders to be able to have it with somebody, like you said, who cares, who really cares and knows the way forward.
Yeah, so I would say we have a concentration of investments in New York City, um, increasingly more so in Seattle, including Tyler, who's just ranked one of the top upcoming young VCs, who's a VP at our team, moved to Seattle. We have a couple of firms there. I'll be up there in mid-June for Team Sense, his board meeting, in LA, and then the rest is sort of spread.
Okay.
You know,
How is your deal flow from the South? And the way I define it a little bit to give you more sense of that, it's that 16 state area defined by the census. So we're talking about Texas, Oklahoma, all the way over to Virginia, and certainly Florida, Georgia, Raleigh, Durham, and those areas. Is that a significant part of Bonfire's deal flow today?
I'd probably say we get less inbound because we're not there in person. But from an outbound perspective, in terms of prospecting or relationships, we look at many companies, right? We have a number of investment. I don't really consider Texas part of the South. So I was ready for this question. Like, what is she going to call the South? She gave me Virginia, south of the Mason-Dixon line. I grew up in Maryland. But, we do spend a bunch of time in Atlanta, right? So we've invested in FlowPath and Turiel and continue to look at companies there. So I wouldn't say we get as much inbound because, if you think about a lot of our inbound relationships are from our networks over the years, right?
Yeah. Well, and I look forward to sending you as many opportunities as possible. Don't worry, that we'll continue to keep your inbound coming.
Look, I think we spent some time. I was out there for Atlanta Tech Week last year.
Yeah.
I like the founders, I like in many of those states, I like the diversity of the population.
Right.
I'm on the board was an early angel investor, and I'm on the board of Pendo in Raleigh. Raleigh's an amazing town. And so to me, I don't really think of the South any different than other regions. I would just say I think we're working on building tighter and tighter relationships with folks like you and others to go work on deals together. But it's just hard from a travel perspective. Like, I'm not going to go on a bus tour of the South.
I am the same boat. I also, this is this post-COVID era, and we do care greatly about our founders. And one of the reasons we keep our investment geography tight, we only lead seed rounds in the South, is just this issue you're talking about, the scaling of our team and making sure that each founder has a quality relationship with a leader investor at Valor that has some been there, done that experience to offer. And it's a very real thing. I was recently running the numbers from PitchBook, and I discovered this year so far, 1 out of every 3 seed deals are actually done in the South. So the South is really rising in terms of its volume, and I expect you'll find more and more opportunities here.
And then what was the average valuation of a pre-seed or seed deal done in the South versus in the West?
It was a 20% difference. Yeah. How did you know I looked?
I would have thought it was more.
Yeah, I can actually I'll send you the report. No, it's a kind of something we share with LPs and anyone who's really interested. But technically, PitchBook data, I think, is directionally accurate, but it's by no means, second decile kind of accurate. I wouldn't go that far, but 16 to 20% lower valuations in the South than the average valuation across the country that's not the South. So I imagine it's even steeper, to your point, in the West. I did not look at West versus South.
Well, I think the other interesting thing is talking about West versus South, maybe where the company has started. But if we're talking about a 10-year journey and trying to think about where the concentration of employees will be, look, I have my own personal belief about remote work versus not. My general belief is if you're under 30 years old, remote work is a disaster. Being in person, especially in go-to-market roles and the rest of it, knowledge by absorption and these learning loops, and having a sense of family and community. As the world's gotten lonelier and more isolated with social media for kids. Really important. But the interesting thing, if we're funding a company in LA or San Francisco, beyond like the 30th or 40th employee, from a CAC perspective, unless they have some magic trip the light fantastic economic model, they got to be in the rest of the United States. And so there are a lot of companies that may have started in the West, but if 100, 200 employees, and you start to look at where the concentration of employees are, whether that's in Austin, whether that's in Nashville, whether that's in Atlanta, whether that's in Carolina, we have a lot of terrific universities and technical universities in there where we can build hubs of people as we build those companies out. So it's kind of interesting. We talk about West versus South versus East at funding. And then if you said, okay, now the company's 100, 200 employees, what would you call it? And so
I agree. That's just so well said. Companies, I tell people, venture is a global sport. You're building a globally valuable business. At some point, you are a multinational footprint business, even getting past the country. And so it, in a way, doesn't really matter where you start, as long as you've got the right setup for success. And so I'm looking at the time, and this time has flown by, and I know you run a crazy busy schedule with your founder updates, your board meetings, and meeting new founders. How should a founder who's heard this, listen to your wisdom and thought, wow, I'd like to get this in front of Bonfire, how should they reach out to the organization?
Sure. One, just understand, we write $2.5 to $3 million checks. And that check should get you to a Series A within 2 years. And a Series A is like $2 million in revenue. So one, you need to have product in market, and you need to have significant revenue traction, 3, 4, 500,000 ARR. Now, if you're usage-based, maybe it's a little early, but if you're usage-based, you got to have a lot of usage and some sense of monetization. And so, you can just send me a message on LinkedIn if you want to talk to me. I will try to respond as best we can, with the understanding that, the weirdest part about this business, Lisa, I love all founders. I want them all to win.
Right.
The weird part about the business is, like, you talk to 500, you get down to 100, then you go deep with 30, and you say yes to 1. It's like the shittiest part about this job.
I agree.
At least I try to write a very thoughtful why, try to be helpful, and try to introduce them to others that may. Because it's not that you're a bad investment. It's that I found the one other thing that's more compelling. And I know that sounds like horseshit. And I know that sounds like, an excuse, but it's true. And that's the hardest thing, to say no with grace. So we'll try.
I hear you loud and clear. And everyone, we're going to put Brett's LinkedIn profile right in the show notes and right with this episode, so you don't have to look too far or worry how to spell it if you're listening in your car. Brett, you've been so gracious and generous with your time. I look forward to seeing you again soon and finding ways to work together. And thank you for sharing.
Thank you for including me. Let's find a deal.
Do it. I want it. Take care.